the valuations and how we stood before yesterday's sell-off. Give us a little bit of perspective there, and I guess you assume it was justified.
Well, I guess it's justified. We're still high, though. I emphasize this CAPE ratio, cyclically adjusted price-earnings ratio. It was down to 13. That's a sort of price-earnings ratio. It was 13 in the bottom of the market in 2009, and now it's almost 30. So it's high. But that doesn't tell you what it's going to do in the next few days. It just says that maybe sometime in coming years it will have a correction down. It's not a great time to be investing in the stock market.
I want to bring in Jonathan Golub of RBC, Professor. Jonathan, you listened to the Professor's remarks. What do you have to say back to that we're incredibly high and it's not a great time to buy into the equity market?
Well, and I think that Dr. Shiller raises the most important point. This is not a good intermediate-term indicator of where the stock market is going. Now, what investors tend to focus on, whether it be guys at hedge funds or mutual fund companies, is forward stock multiples. And 17.5, just like Dr. Shiller's CAPE number, is high compared to history, but it's gone to substantially higher levels. And to me right now, you're not seeing the indications such as recessionary risk that would tell you that there's risk in the very near term that this thing is going to roll over. So expensive, yes. Likely to be more expensive before it's over, also yes.
Well, and fair point, Professor. If you take a look at where it's been and you compared the optimism in the market today versus where we were back in 2000, but the CAPE ratio there was near 45 at the end of the day. A very different story.
Yeah, I agree. I haven't really sold my stocks. The competing real estate and fixed incomes aren't so great either. So I think that, and it's also correct that expectations are high under Trump. According to my own surveys, I find evidence of that. Confidence in the valuation of the market is low. But that still sounds like the 1990s. You know, it still could go way up. I agree.
Yeah, the one big difference, Alex, between now and I think the late 90s was the companies that were expensive then were companies that we had massive hope in, the AOLs or the tech companies with no earnings and a promise of something in the future. If you look at today's growth companies, the Googles and the Facebooks and the Amazons, these are companies with solid earnings and cash flows that are, I wouldn't even say mature companies, but are maturing companies that are very different. And the companies that are actually being bid up, in many cases, are the really stable companies in consumer staples and in some of these bond proxies that the market is putting a higher valuation. So while there's optimism in today's market, and I think that there should be, it doesn't really feel, there's a different tone today than there was in the 90s.
Well, Professor, I actually hear that comparison made beyond equity markets and in credit as well. Leverage has been building up in credit no matter what grade you look at. But the pushback I get is that they're higher quality companies. They have better cash flow, et cetera, et cetera. What do you say back to that, Professor, that actually the valuations are steep compared to the 90s? Yes, they're still there. But actually the quality of the companies are better?
Are you asking me?
Yes, Professor, yes.
Yeah. Yes, I think back in the 1990s, it was a gold rush mentality. And there was the new idea then was that companies shouldn't be focused on earnings because it's a stake your claim time, a turning point for the whole world with the internet just coming in. And obviously the internet would be very important. So you just lost mooring. But now we're back into a more normal environment. Yeah, we're talking about big companies that were founded 20-some years ago, and we're no longer, I don't hear it so much, that companies shouldn't worry about earnings. Now we expect earnings.